According to our data, investors are moving lockstep to stocks, commodities, and emerging markets. But some analysts say the herd mentality can hurt you. Eric Martin wrote this exclusive story for Bloomberg. Good afternoon.
Hi, Carol. How are you?
I'm doing okay. So why are we seeing, what do we got? Oil, stocks, hedge funds so closely correlated?
So many of the assets that we've seen rallying since mid-March are correlated and depending on an improving economy. If you think about stocks, investors getting back in, and also some of the industrial metals, you have copper has been rallying, as well as things like oil. They're all plays on an improving economy. What we're hearing from some investors are that, well, the Armageddon scenario for the economy has been now taken off the table, but this economy isn't necessarily recovering as quickly as some of these assets are reflecting.
Well, that's a good point. I mean, Eric, there's so much debate out there whether or not, we talk about these green shoots and things starting to get maybe not worse, but at least leveling off. I mean, why shouldn't stocks and commodities be rallying in advance of that?
It certainly makes sense for them to rally, but we've now had the steepest rally in 7 decades, 40% off the bottom.
It's a huge bounce.
It's a huge bounce, and what's scaring some investors is the idea that oil and stocks are rallying so closely together. If you look at a graph of the oil market and the CRB commodities index.
Right, which is what we've got here.
If you look at that, since March 2nd and March 9, when commodities and stocks bottomed, they've been rallying almost as a mirror image.
And that's unusual?
That is unusual. For the commodities index, it's the highest correlation since the 1950s when data began. And we're also seeing for oil the highest correlation. So one being perfect, this is at about 0.7, the correlation, and that's the highest we've seen for either of those two measures.
So, Eric, a warning sign to the folks that you've been talking to? I know you talked to a lot of folks for your article.
Absolutely. A lot of investors saying that, that we can't necessarily depend on this rally to continue without better economic data. What we've seen so far is a deceleration in the slowing, but for the most part, the economy is still slowing down. We really haven't seen signs of a strong recovery. Many very well-known and respected investors, Warren Buffett among them, he was on Bloomberg TV last week talking about the fact that the turn for the economy doesn't necessarily look like it's right around the corner.
Right. What does all this mean, though, like for diversification strategy? I know some of that was brought out in your article.
Right. And in past times, investors have been able to buy oil if stocks were starting to fall, as we saw last summer when oil was peaking around $147 a barrel, while stocks had begun to sell off. This time, they're having to look farther afield for some of those kind of strategies to hedge against any potential economic risk. Gold is certainly an asset class that investors always look at as a haven.
Right.
Treasuries usually would be, but in this climate, with the amount of issuance, as Brian just mentioned, and what's been going on to pay for the government programs, you really can't depend on treasuries rallying.
All right. So if investors can't really diversify here, if that's kind of out the window, I mean, what are they buying as a hedge against a potential sell-off, which many say we could see? Right.
The investors I spoke with said that high-grade corporate bonds are a good place to be diversifying at this time.
Right.
Also, a lot of them are taking a little bit of risk off the table, maybe looking at cash, not just as a place to hold money before deciding where else to invest it, but potentially as a store of value, even with inflation potentially looming on the horizon. It is someplace that maybe you want to actually have an allocation rather than it being a middle ground between investments.
All right. So bottom line, because there is such a is this the closest correlation we've seen ever?
Closest correlation ever for the commodities index and the S&P 500.
All right. So bottom line, investors should take what away from all of this?
Investors should take away an idea that they should be diversifying outside of just materials and stocks, maybe looking at some alternative types of investments, and then not thinking that just because the rally has been so strong up till now, it will continue. The risk-reward equation at this point, investors are telling us, favors a little bit more caution after 40% off the bottom in the S&P 500.
Hey, Eric, safe to say, though, that there should be some correlation or no?
There has been some correlation in the past. Gold is one asset that, as I mentioned, is fairly uncorrelated to stocks. We've seen some correlation in the past, but what's scaring people now is the idea that last year you had all of these things being really pummeled kind of together.
Right.
People were selling whatever they could, whether it was for redemptions or to raise money just to keep the doors open for some firms. Everything was being sold off together. What's a warning sign to investors now is that everything is rallying together. So should there prove to be a disappointment in the economy, things could sell off just as easily. You could be back to the scenario of selling whatever you can, everything falling in lockstep as it's been rising for the past 3 months.
So be a little bit cautious out there would be prudent, I guess.
Absolutely.
All right. Our own Eric Martin. Eric, thanks so much. Appreciate it.
Thank you.
Bloomberg News' Eric Martin.